All right, let's pull back the curtain on the very architecture of our economy. We're going to explore the hidden tools that build fortunes, manage risk, and, well, are now being completely reimagined by technology.
I mean, really think about that for a second. From the price of your coffee in the morning to those massive container ships crossing the ocean, pretty much everything is underpinned by a massive web of these agreements. They're called financial instruments, and they are, without a doubt, the invisible engine of global commerce.
So, what are we actually talking about here? Well, at its core, a financial instrument is just a contract that has monetary value. It can be proof that you own a piece of a company, or a promise of repayment, maybe even the right to buy something later on. These are the fundamental legal building blocks of all finance.
Okay, so to really get a grip on this, let's start with the basics. What are these instruments actually designed to do, and how do we even begin to categorize them?
Every financial instrument, it doesn't matter how complex it seems, is really just doing one of these four jobs. It's either pooling money together for growth, protecting someone against risk, giving people a way to invest, or just acting as a form of payment. Honestly, without them, our modern economy just couldn't function.
So, this breaks everything down into two main toolkits. On one side, you have cash instruments. Their value is pretty straightforward, determined directly by the market. But on the other hand, you have derivatives. They're a little more abstract since their value is tied to something else, like the price of gold or oil. It's really the difference between owning something versus managing its risk and opportunity.
Let's dive into that first toolkit. We'll look at the most common instruments people use to own a piece of a company. This should make these concepts a whole lot more concrete.
So, when you buy a share of common stock, you're literally buying a tiny piece of a corporation. You're making a bet on that company's future growth. And as a part owner, you usually get voting rights, which means you get a say in how the company is run. It's all about getting in on the upside. Now, preferred stock, that's a different flavor of ownership altogether. Here, the focus isn't really on growth, but on income. See, investors trade away their voting rights and that high growth potential for a fixed, regular dividend payment. It's a much more conservative approach, built for stability over those explosive gains.
And right here, you can really see that trade-off in action. With common stock, you get the voting rights, you get that high growth potential, but you're last in line if things go south. With preferred stock, you give up that control for the safety of a fixed income and getting paid first. It's exactly how companies attract different kinds of investors who have totally different goals.
Okay, let's switch gears and move to our second toolkit. We're shifting from instruments of ownership to instruments designed to manage the financial world's one true constant: uncertainty. So here's the crucial point. A derivative's value is derived from some other underlying asset, but you never actually trade the asset itself. Think about an airline, for example. They might use a derivative to lock in a future price for jet fuel to protect themselves from price spikes. That's called hedging. Or a speculator could use a derivative to just bet on which way that fuel price is going to go. Now, before we jump into specific derivatives, it's absolutely crucial to know how they're traded. There are basically two main avenues. There's over-the-counter, or OTC, which is like a private, custom-made deal. And then there's exchange-traded, which is public and totally standardized. And as you're about to see, that difference has huge implications for risk. A forward contract is that private, customizable OTC deal we just mentioned. Its cousin, the futures contract, is standardized and traded on an exchange. And here's the trade-off, right? A forward gives you that perfect customization, but you're taking on the risk that the other side might not pay up. With a future, you lose that custom fit, but a clearinghouse guarantees the trade, which makes it a whole lot safer.
All right, let's zoom back out. Because these days, it's not just about the instruments themselves anymore. There are powerful new technologies that are fundamentally rebuilding the entire financial system right from the ground up.
And this quote, it really captures the incredible scale of this revolution. We're not just talking about minor tweaks here. We're talking about moving toward a world of hyper-personalized finance, where AI can tailor services directly to you, proactively.
And it's not just about the customer experience either. Behind the scenes, AI is creating these massive efficiencies. Just take risk and compliance. That's a huge, labor-intensive cost for every single bank. We're talking about a potential 60% cost reduction in that area alone. Just imagine what that means. It frees up billions of dollars and countless hours that can be reinvested into developing new products and technologies. So it really boils down to these three powerful forces. You've got AI driving that personalization and efficiency we just talked about. Then you've got blockchain and tokenization creating entirely new kinds of digital assets. I mean, think of a stock or a bond that you can trade instantly, 24/7, without a traditional exchange. And, of course, you have regulators scrambling to write the new rulebook for this digital world, trying to encourage innovation without, risking the stability of the whole system. So, what's the bottom line here? With all this change happening so quickly, what are the key takeaways for actually navigating this new financial landscape? Well, for investors, the message is pretty clear. You have to diversify beyond the basics and pay really close attention to these tech trends. For companies, it's even simpler. Go digital, or you will be left behind. And for policymakers, the challenge is immense. How do you build guardrails for innovation without just completely stifling it? It is a serious tightrope walk for everyone involved. And that leaves us with this final critical thought. We are witnessing the reinvention of money, of value, and of trust, all in real time. The instruments are evolving, the systems are being rebuilt, and the pace of this change is only getting faster. The question really isn't if this is happening anymore, but how quickly can we all adapt to a future that is, for all intents and purposes, already here?